Before we begin, please remember that this video is for educational and informational purposes only. I am not a financial advisor, and the content in this presentation is not intended to be a substitute for professional financial, legal, or tax advice. The world of insurance and finance is complex and highly individual. Always consult with a licensed and qualified professional who can assess your specific situation before making any financial decisions. Your financial future is your responsibility, and the choices you make should be based on personalized guidance. Imagine for a moment you're 68 years old. You've been paying into a life insurance policy for 25 years straight. Every single month a payment goes out, a safety net for your spouse, a legacy for your kids. It's the responsible thing to do. Then one Tuesday afternoon you get a letter. It's not a bill. It's a notice. An in-force illustration, it says. You scan the pages of confusing numbers and your heart sinks. Buried in the fine print is a sentence that feels like a punch to the gut. Your policy is projected to lapse, to terminate, in just 3 years. Worthless. The quarter-century of payments you made? Gone. The $500,000 death benefit your family was counting on? Evaporated. This isn't a hypothetical horror story. This is a quiet crisis happening in mailboxes all across America, and it almost always involves one specific, powerful, and dangerously misunderstood financial tool: universal life insurance. If that name, Universal Life, makes you feel a little confused, or maybe even a little anxious, you are not alone. It has been called everything from the greatest wealth-building secret on Wall Street to a ticking time bomb designed to fleece consumers. And you know what? Both can be true. The difference between those two outcomes, between a financial cornerstone and a catastrophic failure, is knowledge. And that is exactly why you are here. This video is going to give you that knowledge. We are going to pull back the curtain on universal life insurance. We're going to strip away the jargon, the confusing sales pitches, and the dense 80-page policy documents and explain it so simply, so clearly, that by the time you're done watching, you will understand how this product really works better than 99% of the population, and maybe even better than the person who sold it to you. We're going to arm you with the critical information you need to either manage a policy you already have, or to make a smart decision about whether it's right for you in the future. We are going to turn confusion into confidence. Let's be brutally honest for a second. The entire insurance industry can feel overwhelming. It's an alphabet soup of acronyms: UL, IUL, VUL, WL, and it feels like you need a secret decoder ring just to understand the brochure. An agent sits at your kitchen table talking about premiums, face amounts, cash value, and mortality charges, and you just nod along, hoping you're making the right choice for your family. You sign on the dotted line, you start making the payments, and you file the policy away, hoping you never have to think about it again. But with universal life, not thinking about it is the single most expensive mistake you can make. Unlike a simple term life insurance policy, which is like renting coverage, a universal life policy is something you own. And like anything you own, whether it's a house or a car, it requires a little bit of understanding to maintain it properly. So let's build it from the ground up. I want you to forget everything you think you know about life insurance for a minute. I want you to picture a simple bucket. That's it. Just a bucket. This bucket represents your universal life policy, and there are only 3 moving parts you need to understand. First, there's the water you pour into the bucket. This is your premium. It's the money you pay to the insurance company. Now, here's the first big, important difference with universal life. The universal part means you have incredible flexibility. Unlike other types of permanent insurance where the payment is fixed and rigid, with universal life you have a choice. You can pour in a lot of water, just a little bit of water, or sometimes no water at all for a period of time. You can pay a minimum amount designed to just keep the policy afloat, or you can pay a maximum amount designed to fill that bucket up as fast as possible. This flexibility is the product's greatest strength, and also its greatest weakness, as we'll soon see. But for now, just remember, premiums are the water you pour in, and you control the spigot. Second, there's a tiny invisible hole in the bottom of the bucket. Every single month, a little bit of water drips out. This is the cost of the actual life insurance. It's the mortality charge, the administrative fees. It's what you pay the company for the promise that if you die, they will pay your family a large tax-free death benefit. Think of it as evaporation. Every month, the sun comes out and a little bit of your water evaporates. Now, here is the absolute most critical piece of information you need to grasp. The amount of evaporation changes over time. When you're young and healthy, the sun is weak. Very little water evaporates each month. The cost of insurance is dirt cheap. But as you get older, the sun gets hotter. Every single year, the cost of that insurance, the amount of evaporation gets a little bit higher. It's a slow, gradual process, but it never stops. The cost of your insurance at age 40 is a fraction of what it will be at age 80. This rising internal cost is the engine that drives everything inside a universal life policy, for better or for worse. Third, there's the water level inside the bucket. This is your cash value. It's the money that's accumulated inside your policy after you've poured in your premiums, and after the monthly evaporation of costs has dripped out. But this water isn't just sitting there stagnant. The insurance company takes this cash value and invests it, and in return they pay you interest. So, picture rain falling back into your bucket every month. The interest crediting is like rainfall, replenishing the water level. The goal, the entire design of a healthy policy, is to get to a point where the monthly rainfall, the interest you're earning, is greater than the monthly evaporation, the costs that are leaking out. When you achieve that, your policy can essentially start paying for itself. It becomes a self-sustaining financial machine. So, let's go back to that horror story from the beginning. What happened to those people whose policies collapsed after 25 years? Their bucket ran dry. For years, they were sold on the idea of paying the lowest possible premium. They were only pouring in just enough water each month to cover the small amount of evaporation. Their water level, their cash value never really grew. But they got older. The sun got hotter. The internal cost of their insurance, the evaporation, started increasing dramatically. Soon, the evaporation was happening faster than the water they were pouring in. The water level in the bucket started to drop faster and faster, until one day it was completely empty. And when the bucket is empty, the insurance company terminates the contract. Game over. This is the fundamental trade-off of universal life. The flexibility of the premiums is a powerful tool. It allows you to overfund the policy in your high-earning years to build a massive cash value, or to reduce payments during tough times. But that same flexibility, when misunderstood or misused, can lead you to chronically underfund the policy, creating a ticking time bomb that won't go off for decades. But when it does, it's devastating. But what if you could control the weather? What if you could build a policy where the rainfall was a downpour and the evaporation was just a mild mist? That is the promise of a properly structured universal life policy. It's about more than just a death benefit. It's about turning that bucket, that cash value, into a tax-advantaged growth account, a source of tax-free retirement income, or a way to fund major life expenses. We've just laid the foundation. You now understand the three core mechanics: the flexible premiums, the rising internal costs, and the interest-earning cash value better than most. But this is just the beginning. Now that we understand the what, we're about to dive into the how. We'll explore the different types of universal life, from the fixed interest kind to the ones linked to the stock market, and reveal how that rainfall of interest is actually calculated. We're going to show you how to read those confusing illustrations from the insurance company so you can see for yourself if your bucket is on track to be full or on a path to run dry. So let's pull back the curtain on that piece of paper the insurance agent slides across the table. It's called an illustration, and it's basically the insurance company's weather forecast for your bucket of money. It's their prediction of how much rain is going to fall and how fast the water is going to evaporate over the next 20, 30, even 50 years. And just like a weather forecast, some parts are more reliable than others. When you look at this illustration, you'll almost always see two main columns of numbers, sometimes three. The two most important are labeled guaranteed and non-guaranteed. And this is the first, most critical fork in the road to understanding your policy. Let's start with the guaranteed column. I want you to think of this as the absolute worst-case scenario. This is the drought forecast. This column shows you what will happen to your bucket if the insurance company only gives you the bare minimum amount of rain they are legally required to, while simultaneously charging you the absolute maximum fees they are allowed to. This is the contract. This is the only part of the illustration that is a legally binding promise. And frankly, when you look at this column, it's usually terrifying. You'll often see the cash value, the water in your bucket, stagnate and then start to drop. And in many, many cases, you'll see it go to zero. The illustration will literally show the policy lapsing or dying long before you do. Your bucket runs completely dry. This is the insurance company covering themselves, showing you in black and white that if the financial weather gets bad enough for long enough, your policy could collapse under the weight of its own costs. Most people's eyes glaze over here, or their agent tells them, "Oh, don't worry about that column, that'll never happen." But ignoring this column is like a pilot ignoring the emergency checklist. It's the one thing you absolutely need to understand. Now let's look at the other column, the one your agent probably pointed to with a big smile. This is the non-guaranteed column, sometimes called the current assumptions column. This is the perfect sunny day forecast. This column shows what could happen to your bucket if today's pleasant weather continues forever. It assumes that the interest rate the company is paying right now will continue to be paid every single year for the rest of your life. It also assumes the costs they are charging right now will never go up to their maximums. This is the column that shows your bucket filling up and overflowing. This is the column that shows you becoming your own bank, taking out tax-free loans, and funding a glorious retirement. And it is possible, but it is not a promise. It's a projection. It's a guess. It's marketing. And buying a policy based solely on the non-guaranteed numbers is like planning a 30-year-long beach vacation based on today's sunny forecast. It's optimistic, but it's not realistic. So where does this non-guaranteed rain fall? The interest actually come from? It's not magic. The insurance company takes your premium payments, and after they skim off their costs, they invest the rest in their general account. This is a massive, conservative portfolio of investments, mostly high-grade corporate bonds. The return they get on this giant portfolio determines the declared rate of interest they can offer you. So, let's say the company's portfolio earns 5.5%. They might then declare a rate of 4.5% for their policyholders. That 1% difference is their profit, their spread. That 4.5% is the rate of rainfall for your bucket that year. But it gets more complicated, especially with the most popular flavor of universal life today, which is Indexed Universal Life, or IUL. With an IUL, the rainfall isn't tied to the insurance company's boring bond portfolio. Instead, it's tied to the performance of a stock market index, most commonly the S&P 500. This sounds amazing, right? You get the upside of the stock market without the risk of losing your principal. That's the sales pitch. But here's how it really works. The insurance company uses options and other derivatives to track the index. It's a complex system, but for you, the consumer, it boils down to three critical components that control your rain: the cap, the floor, and the participation rate. First, the floor. This is the safety net. It's the minimum guaranteed interest you can earn, even if the stock market crashes. The floor is almost always 0%. So if the S&P 500 goes down 20%, your cash value doesn't lose a dime. You just get a zero for the year. No rain, but no catastrophic drain either. This is the primary benefit of an IUL. Next, the cap. This is the ceiling. The insurance company puts a limit on your potential gains. So, if the S&P 500 goes up 20% in a year, and your policy has a 9% cap, guess what? You don't get 20%. You get 9%. The cap is like an umbrella that opens up during a downpour, keeps you from getting soaked with gains. The insurance company keeps anything above that cap. Caps can and do change over time. When you buy the policy, the cap might be 10%, but 5 years later, the company could lower it to 7%. They have that right. Finally, there's the participation rate. This is how much of the index's gain you get to participate in up to the cap. Most of the time it's 100%, which is simple. If the index goes up 8% and the cap is 9%, you get 8%. But sometimes, a policy might have, say, a 75% participation rate. In that case, if the index goes up 8%, you first multiply that by 75%, which gives you 6%. Since 6% is below the cap, that's your interest credit for the year. It's another lever the insurance company can pull to limit how much rain actually makes it into your bucket. So let's put it all together. You look at the non-guaranteed illustration, and it shows your cash value growing at a steady, beautiful 6.5% every single year for 40 years. Your bucket is overflowing. But where did that 6.5% come from? The agent or the software just plugged in a hypothetical average. They assumed a consistent, never-ending sunny day. But reality is never a smooth, straight line. The market has great years, terrible years, and flat years. One year you might hit the 9% cap. The next year the market is down and you get the 0% floor. The year after that it's up 5%, so you get 5%. The illustration's smooth 6.5% average hides this volatility. And here is the devastatingly simple reason why so many of these policies implode. It's the sequence of those returns. The non-guaranteed illustration assumes a steady rain. But what if you have a drought for the first 5 years you own the policy? What if you get 0%, 0%, 2%, 0%, and 1%? During that time, the water in your bucket isn't growing much, if at all. But the evaporation is still happening. The costs are still coming out. Every single month, The company is taking a scoop of water out of your bucket to pay for the insurance and the fees. When you have several years of low returns, those costs start eating away at your principal, at the money you put in. The water level drops. And if it drops too low, it can enter a death spiral where the costs represent such a large percentage of the remaining cash value that the bucket can never, ever refill. It's guaranteed to run dry. This is the core misunderstanding. People buy the sunny day forecast. They see the big number at age 65 on the non-guaranteed column. But they don't realize that this forecast is built on the fragile assumption of consistent, positive returns that may never happen in the real world. They don't see that a few bad years early on can put their bucket on a path to emptiness, regardless of how sunny the weather gets later on. So we've talked about the rain, the interest that makes your money grow. But what about the other side of the equation? What about the evaporation and the leaks? What are these costs that are constantly, silently draining the water from your bucket, month after month, year after year? Because understanding these costs is just as important as understanding the growth. In our next part, we are going to expose every single one of them. We'll break down the cost of insurance, the premium load, the administrative fees, and the surrender charges. We're going to show you exactly where every dollar of your premium payment goes, and how to spot a policy that's designed to drain your bucket instead of filling it. So let's start by following your premium payment on its journey. Imagine you write a check for $1,000 and send it to the insurance company. You picture that $1,000 being deposited into your account, your little financial bucket, ready to start earning interest. But that's not what happens. Before your money even sees your bucket, it runs into its first obstacle, the premium load charge. Think of this as a cover charge at a club. It's a fee skimmed right off the top of every single premium payment you make. This charge is primarily designed to pay the sales commission to the agent who sold you the policy. It can range anywhere from 3 to as high as 10%, or even more in some older policies. So, right off the bat, your $1,000 payment becomes $950, or maybe $900. 50 or $100 gone, vanished before it ever had a chance to work for you. This is a front-end load, and it's a direct reduction of the capital you're trying to build. Okay, so your $950 made it past the front door. Now what? Well, now it faces a constant, nagging drain, the administrative fees. These are the ongoing costs the insurance company charges just for maintaining your policy. They might be called a policy fee, an expense charge, or some other vague term. It can be a small flat monthly fee, say $5 or $10 a month, or it can be a small percentage of your cash value. It might not sound like much, but think of it as a tiny pinprick-sized hole in the bottom of your bucket. $5 or $10 a month is $60 or $120 a year. Every year. For the life of the policy. Over 30 years, that's thousands of dollars that just dribbled away. It's the cost of keeping the lights on at the insurance company, and you're the one paying the bill. So we've paid the cover charge to get in, and we're paying the monthly membership dues. But now we come to the big one, the most significant, most misunderstood, and most dangerous cost inside a universal life policy. The cost of insurance, or COI. This is the real price you pay for the death benefit. It's the pure mortality charge. It's what the insurance company charges you each month for the promise to pay your beneficiaries if you die. In our bucket analogy, this isn't a one-time scoop off the top or a small leak at the bottom. The cost of insurance is like evaporation. It's a silent, invisible force constantly pulling money out of your bucket. And here is the critically important part that you have to understand. This cost is not level. It goes up every single year. When you're young and healthy, the cost of insurance, the evaporation, is minimal. Few dollars a month. But as you get older, your statistical probability of dying increases. So the insurance company increases your cost of insurance to match that risk. It doesn't just go up a little, it accelerates. The cost curve starts out nearly flat, but then it begins to steepen, and in your later years, your 60s, 70s, and 80s, it becomes almost a vertical wall. This is the internal time bomb that causes so many universal life policies to fail. People pay their premiums for years, thinking they're building a nice nest egg, but they don't see this rising internal cost silently eating away at their cash value from the inside out. The evaporation gets so intense that it starts pulling more money out of the bucket than the premium and the interest are putting in. And that's when the bucket starts to empty, leading to that dreaded lapse we talked about earlier. Now, to make this even more complex, the cost of insurance is only charged on something called the net amount at risk. That sounds technical, but the concept is simple. Let's say you have a policy with a $1 million death benefit. In year one, you have almost no cash value. So if you die, the insurance company is on the hook for the full $1 million. That's their risk. But let's say 20 years later, you've built up $200,000 in cash value. Now, if you die, the insurance company only has to come up with $800,000 to make up the $1 million death benefit, because your own $200,000 of cash value makes up the rest. So their net amount at risk is now only $800,000. The cost of insurance is a monthly charge based on your age, and this net amount at risk. And this is where the two main types of universal life death benefit options come into play, usually called Option A and Option B. Option A is a level death benefit. This is the most common option. It means if you buy a $1 million policy, the death benefit is always $1 million. But think about what this means for the net amount at risk. As your cash value grows, the net amount at risk shrinks. A lower amount at risk should mean a lower cost of insurance, right? It helps offset your increasing age. This sounds good, but it's a double-edged sword. A lower cost of insurance means more of your premium can go towards cash value, which makes the cash value grow faster, which in turn reduces the net amount at risk even more. This can be efficient for cash accumulation, but it also means that in the end, you are essentially funding more and more of your own death benefit. Option B is an increasing death benefit. This means the death benefit is the face amount plus your cash value. So if you have a $1 million policy and $200,000 in cash value, your beneficiaries get $1.2 million. With this option, the insurance company's net amount at risk is always the full $1 million, because your cash value is paid out on top of it. What does this mean for your costs? It means your cost of insurance will be much higher, especially in later years, because it's always being calculated on that full face amount. This option is far more expensive and will lead to much slower cash value growth, but it provides a larger legacy. Understanding which option you have is absolutely critical to understanding the future of your policy. Okay, deep breath. We've covered the premium load, the administrative fees, and the big one, the ever-increasing cost of insurance. But there's one more nasty surprise waiting for you, and it's called the surrender charge. This is the ultimate gotcha. The surrender charge is a massive penalty the insurance company hits you with if you try to cancel your policy or withdraw a significant amount of your cash value in the early years. And early years usually means the first 10, 15, or even 20 years of the policy. Think of it as a brutal hotel cancellation policy. You try to check out early, and they keep almost all of your money. A typical surrender charge schedule might start at 100% of a target premium in year 1, and then slowly decrease each year until it finally disappears after, say, year 15. This means that for the first decade and a half, the cash value you see on your statement is not the same as the cash surrender value you can actually walk away with. The surrender value is your money minus this enormous penalty. Why do they do this? It's to make sure they recoup the huge commission they paid the agent up front and to lock you into the policy. It creates golden handcuffs. You could be 5 years into a policy, realize it's a terrible deal with high costs and low returns, but you can't leave. If you try, the surrender charge will wipe out most, if not all, of the cash value you've painstakingly built. You're trapped. You're forced to either keep feeding a poorly performing policy or walk away with a massive loss. So let's put it all together. Your premium payment first gets a haircut from the premium load. What's left goes into the bucket, where it's immediately subjected to a slow, constant drain from administrative fees. At the same time, the powerful force of the cost of insurance is causing your cash value to evaporate, and that evaporation gets stronger every single year as you age. And the entire bucket is surrounded by a 15-year-long electric fence called a surrender charge, preventing you from taking your money out without a painful shock. When you see all these costs working together, it's a wonder any cash value accumulates at all. So with all these forces draining your bucket, how is it supposed to ever get full? Well, that's where the insurance company's big promise comes in: interest. But how that interest is actually calculated is one of the most misunderstood and misrepresented parts of universal life. And in the next part, we're going to expose the difference between the guaranteed rate, the current rate, and the illustrated rate, and why the number they show you in the sales pitch is almost never the number you actually get. So let's pull back the curtain on this magic trick. When an insurance agent sits down with you, they pull out a document. It's usually dozens of pages long, filled with columns and numbers, but they'll point to one specific page, one specific column, and one very specific, very large number at the bottom. This document is called an illustration, and it's the most powerful and most misleading sales tool in the entire financial industry. The illustration is designed to show you how your policy could perform in the future. And to do that, it has to make an assumption about how much interest your cash value will earn. This assumption, this projected number, is the illustrated rate. Think of it like the sticker on a new car that advertises its gas mileage. The sticker might say you'll get 50 miles per gallon. That's the illustrated rate. It's a beautiful, optimistic number. It's calculated under perfect, laboratory-controlled conditions. A professional driver on a closed track, no wind, no hills, perfect tire pressure, accelerating at the most efficient speed possible. That's how they get to 50 miles per gallon. In the world of universal life, the illustrated rate is that same perfect world scenario. The agent might show you an illustration projecting your cash value will grow at 6%, 7%, or even 8% per year. Based on that rosy projection, they'll show you that you can pay a relatively low premium, and by the time you're 65, you'll have $1 million in tax-free cash value. It looks incredible. It looks like a no-brainer. But here's the problem. You don't drive in a laboratory. You drive in the real world. You hit traffic, you drive up hills, you turn on the air conditioning, you carry passengers. You're never going to get 50 miles per gallon. The illustrated rate is not a promise. It's not a guarantee. It's a hypothetical, non-guaranteed projection based on assumptions that may or may not come true. And historically, they almost never do. Back in the 1980s and 90s, when interest rates were sky-high, agents were showing illustrations projecting 10% or 12% annual returns. People bought these policies by the truckload, thinking they had found the secret to wealth. A decade later, when interest rates cratered, those policies imploded, and millions of people lost everything they'd paid in. The number they were sold was a fantasy. So if the illustrated rate is the fantasy, what's reality? This brings us to the second number, the current rate. The current rate is what the insurance company is actually paying on its block of policies right now, at this moment in time. If the illustrated rate is the 50 miles per gallon in the lab, the current rate is the mileage you're getting today on a nice flat highway with no traffic. It's real, but it's a snapshot. It can change next month, next quarter, next year. The current rate is heavily influenced by the broader economy, especially the interest rates set by the Federal Reserve. When the Fed raises rates, insurance companies can earn more on their investments, and they might pass a little of that on to you by increasing the current rate. When the Fed cuts rates like they did for most of the last decade, the current rate on these policies plummets. So, the current rate is better than a fantasy projection, but it's still not something you can count on for the next 30 or 40 years. An agent might tell you, hey, the illustrated rate is 6.5%, but our current rate is a strong 4.5%. That sounds reasonable. You might think, okay, 4.5% is still a decent return. But you're missing the most important number of all. The one they bury on page 27 of the illustration in tiny font. This is the number that the entire house of cards is built on. It's the guaranteed rate. The guaranteed rate is the absolute, rock-bottom, legally contracted minimum interest rate the insurance company is required to pay you, no matter what happens in the economy. This is the only number in the entire illustration that is not a guess, not a projection, and not a snapshot. It is a promise. It is the contract. So what do you think this guaranteed rate is? Given that they're showing you illustrations of 6% or 7%, maybe 4%, 3%, in most modern universal life policies, the guaranteed minimum interest rate is 2%, sometimes 1.5%, and in some policies sold today it's 0%. Zero. Let that sink in. They sell you the policy based on a hypothetical 6% return. You might feel comfortable because the current return is 4.5%. But the only thing they actually promise you in the contract is that your money will earn at minimum 2% or 1% or even nothing at all. This is the core of the problem. This is the trap. Let's go back to our car analogy. The illustrated rate is the 50 miles per gallon you get in the lab. The current rate is the 35 miles per gallon you get on a perfect day. The guaranteed rate is the 10 miles per gallon you get driving up a mountain in a blizzard towing a trailer full of rocks with 4 flat tires. It's the absolute worst-case scenario. And here is the critical piece of information. The premium you are told to pay is almost always calculated based on the rosy, optimistic, non-guaranteed illustrated rate. They figure out the lowest possible premium you can pay, assuming you get that 6% or 7% return every single year for the rest of your life. What do you think happens when the policy doesn't get 6%? What happens when it only gets the current rate of 4%? Or worse, what happens if it only earns the guaranteed rate of 2% for a few years? The cash value doesn't grow the way the illustration promised. A massive gap opens up between the fantasy you were sold and the reality you are living. And that gap is where policies go to die. Because while the interest your money is earning can go up and down, there's another part of the equation, a cost inside the policy, that only ever goes in one direction: up. The beautiful, optimistic interest crediting rate is just one side of the coin. It's the engine of your policy, supposedly pushing your cash value forward. But on the other side of that coin is a hidden parasitic cost that is constantly draining your cash value. A cost that gets more and more expensive every single year you get older. This cost is the ticking time bomb inside every universal life policy. And in the next part, we're going to expose what that cost is, how it's designed to slowly bleed your policy dry, and why, when combined with an interest rate that's lower than what was promised, it creates a mathematical certainty that your policy will eventually self-destruct. This mathematical certainty is built around two core components inside every universal life policy. The first is the part they talk about, the cash value and its interest. The second is the part they whisper, the part they gloss over in the illustrations, the single most destructive element in the entire contract, the cost of insurance. Think of the cost of insurance, or COI, as the true price you pay for your death benefit each year. It's not your premium. Your premium is just the money you put into the bucket. The COI is what the insurance company secretly ladles out of that bucket every single month to actually cover the risk of you dying. It is the engine of the entire policy, and it is designed to get more and more expensive every single year for the rest of your life. This isn't a conspiracy. It's just actuarial science. The older you get, the higher the probability you'll pass away. So the cost to insure your life must go up. When you're 35, the cost is pennies. When you're 55, it's noticeable. When you're 75 or 85, it becomes a monster. A ravenous beast that needs to be fed from your cash value. The sales illustration you were shown was designed to hide this monster. It presented a beautiful story where your cash value grows so fast, so powerfully, that it tames the beast. But that story depended entirely on an optimistic, non-guaranteed interest rate. To understand how the trap is sprung, you need to see how the monster is actually calculated. The cost of insurance is determined by a simple-looking formula. It's your COI rate for that year, multiplied by something called the net amount at risk. Those two variables, the rate and the net amount at risk, are the twin engines of your policy's destruction. Let's break them down. First, the COI rate. As we said, this is tied directly to your age. It's a number that is guaranteed to increase every year. It's a one-way street. It starts low, and then in your later years it follows a curve that looks like a hockey stick shooting almost straight up. The insurance company has a table, deep in your policy documents, that shows the maximum rate they are legally allowed to charge you each year. And trust me, when your policy is in trouble, they will charge you that maximum. Now for the second piece, the net amount at risk. This is the most deceptively brilliant part of the entire scheme. The net amount at risk is the difference between your total death benefit and your accumulated cash value. Let's put that in plain English. Imagine you have a $1 million policy. In year one, you have almost zero cash value. If you were to pass away, the insurance company would have to pay out the full $1 million from their own pocket. Their amount at risk is $1 million. Now let's say 10 years later, you've built up $100,000 in cash value. If you pass away now, the insurance company pays your beneficiary $1 million, but they get to use your $100,000 to do it. They only have to come up with the other $900,000. So their net amount at risk has dropped from $1 million to $900,000. This is the concept the agent sells you on. They say, look, as your cash value grows, you are essentially self-insuring a portion of your own death benefit. The insurance company's risk goes down, so your costs should go down too. It makes perfect sense. Sounds wonderful. And in a world of sunshine and rainbows where the interest rate is always high, it almost works. But we don't live in that world. Now let's put the two pieces together. The beast, the cost of insurance, is fed by multiplying that ever-increasing COI rate by the net amount at risk. The entire health of your policy depends on a race. A race between your cash value and your birthday. Your cash value needs to grow fast enough to shrink the net amount at risk. Faster than your age makes the COI rate explode. The sales illustration showed you winning this race in a landslide. Projected your cash value growing at, say, 6 or 7%. In that scenario, your cash value account balloons over time. It shrinks the net amount at risk so dramatically that even when the COI rate starts to spike in your 70s and 80s, it's being multiplied by a much smaller number. The cost remains manageable. The policy survives. You win. But that was a fantasy. That was the non-guaranteed projection. Now let's look at reality. You didn't get 6%. The market changed. Interest rates fell. You got 4%. Or maybe even the guaranteed minimum of 2%. What happens now? Your cash value doesn't balloon. It crawls. It grows at a pathetic pace, barely keeping up with the policy fees, let alone the rising cost of insurance. Your self-insuring portion remains tiny. So when you hit age 75, instead of having $600,000 in cash value to reduce the company's risk, you only have $150,000. The net amount at risk, which was supposed to have shrunk to $400,000, is still a whopping $850,000. And what has your COI rate been doing all this time? It's been marching upwards year after year, completely unaffected by the economy or interest rates, tied only to the fact that you are getting older. It has reached the vertical part of that hockey stick. You have now created the perfect storm. You have a catastrophically high COI rate being multiplied by a stubbornly high net amount at risk. The result is a cost of insurance charge that is astronomical. It's no longer a few dollars being siphoned from your premium. It's hundreds, then thousands of dollars a month being ripped directly out of your cash value. And this is where the death spiral begins. The massive COI charge attacks your cash value, causing it to drop. But what happens when your cash value drops? The net amount at risk, the difference between your death benefit and your cash value, gets bigger. So the next year, the insurance company multiplies that same, now even higher, age-based COI rate by an even larger net amount at risk. The charge is even more devastating. It drains your cash value even faster, which in turn makes the net amount at risk even bigger for the year after that. It is a feedback loop from hell. The policy begins to eat itself alive. The premiums you're paying are no longer enough to cover the cost. The company sends you a letter, a reprojection showing that your policy, the one you were told would last a lifetime, is projected to lapse, to terminate without value at age 82. To prevent this, you must now pay a premium that is 3 or 4 times what you were originally paying. You're trapped. You're in your late 70s. You can't afford the new massive premium. You're too old and your health has likely changed, so you can't qualify for a new, cheaper policy. Your only options are to pour thousands of dollars you don't have into a failing product, or to walk away, surrendering the policy for whatever little cash value is left, losing decades of payments and the death benefit your family was counting on. This is not an accident. It is not bad luck. It is the result of a product designed with a fatal flaw. A flaw that is only exposed by the collision of time and the harsh reality of real-world interest rates. The agent sold you the dream of the non-guaranteed column, but the insurance company built the contract based on the nightmare of the guaranteed one. They knew that if the rosy projections didn't come true, the mechanics of the cost of insurance and the net amount at risk created a mathematical certainty that the policy would eventually consume itself, leaving you with nothing. They built the trap. You and millions of others just walked into it. So how did they get you to walk into it? How did they convince a generation of smart, hardworking Americans to pour their life savings into a product that was mathematically engineered to fail? They did it with a story. A beautiful, compelling, and ultimately fictional story. And that story had a name, the illustration. You remember the moment. You're sitting across a polished desk from a person who seems to have all the answers. They're confident, they're reassuring, and they slide a leather-bound folder in front of you. They open it and there it is. The policy illustration. It wasn't just a piece of paper with numbers on it. It was a work of art. A masterpiece of financial fiction. It was your future, mapped out in neat columns and tidy rows, stretching out for decades. And it was a future that looked incredible. On one side, you saw the premiums you'd pay. A reasonable, manageable number. On the other side, you saw your cash value. And it wasn't just growing, it was exploding. Tens of thousands, then hundreds of thousands, then maybe even $1 million or more, all accumulating tax-deferred. It was a savings account on steroids. And then there was the death benefit, a huge tax-free number that would protect your family no matter what. It was the best of all worlds. The perfect financial product. But it was all based on a series of assumptions. Dangerous, misleading assumptions. The illustration wasn't a promise. It wasn't a contract. It was a projection. It was the financial equivalent of a weather forecast that only predicts sunshine, even as hurricane clouds are gathering on the horizon. Let's pull back the curtain on the 2 great lies embedded in every one of those old illustrations. The first and most powerful lie was the interest rate. Back in the 80s and early 90s, interest rates were high. It wasn't uncommon to see illustrations projecting annual credited interest rates of 8, 10, even 12%, year after year forever. The agent would point to that column and say, "Look at this growth. The policy is projected to perform at 10%. And your eyes would get wide. 10%? My bank is paying 3. This is amazing. But here's the trick. The word they emphasized was 10%. The word they mumbled was projected. That projection was not guaranteed. The insurance company had absolutely no obligation to pay you that 10%. The actual contract, the document you signed, guaranteed a much lower rate. Usually something like 4%, sometimes less. But the agent would wave that away. Oh, that's just the legal minimum. They've always paid more than that. Look at the current rate, that's what you should focus on. They sold you the sizzle of a non-guaranteed projection, knowing full well they were only legally bound to deliver the stake of a guaranteed minimum. They were selling you a dream based on a temporary economic reality, and they were pricing it as if that dream would last forever. The second lie was even more insidious. It was about the cost of insurance, the very thing we broke down in the last part. The illustration you saw showed the current cost of insurance charges being deducted from your account each year. These were the lowest possible charges the company could levy at the time. But remember, the contract gave the insurance company the right to raise those costs every single year, all the way up to a guaranteed maximum. And that maximum was astronomical. Did the illustration show you what would happen to your policy if the company decided to charge the maximum? Of course not. That would have scared you out of the room. It would have shown your cash value being devoured in a matter of years. It would have shown the policy imploding. So they didn't show it. They hid the worst-case scenario in the fine print and showed you only the absolute best-case scenario on the glossy page. They showed you the cost of the flight, but they failed to mention that the cost of fuel could increase by 1,000% mid-flight, and you'd be on the hook for it. These two lies, the non-guaranteed interest rate and the non-disclosed maximum costs, were the parents of the biggest myth in the life insurance industry: the vanishing premium. This was the ultimate sales pitch. The agent would point to a specific year on the illustration, maybe year 10 or year 15, and say, "Right here. See this? You stop paying. The premium vanishes. From this point forward, the policy pays for itself. The cash value has grown so large that the interest it earns is more than enough to cover the internal costs forever. You get to keep the insurance for free for the rest of your life, and the cash value just keeps on growing." Sounded like magic. Sounded too good to be true. And it was. The vanishing premium was a phantom. It was a trick of the light, completely dependent on those high non-guaranteed interest rates continuing forever, and the low non-guaranteed costs staying low forever. It was a calculation that only worked in the fantasy world of the illustration. Think of it like this. Imagine you want to fill a bathtub that has a slow leak. The vanishing premium concept is like saying, just turn the faucet on full blast for 10 minutes. The tub will fill up so much that even after you turn the faucet off, the water level will stay high enough forever, despite the leak. It sounds absurd, right? The leak is the cost of insurance, and it always gets bigger as you get older. The water from the faucet is the interest being credited to your cash value. The vanishing premium promise assumed the faucet would be blasting at 12% forever. But what happened in the real world? Interest rates didn't stay at 12%. They fell. And they kept falling. Suddenly, the faucet was turned down to 8%, then 6%, then 4%. But the leak, that cost of insurance, it didn't get smaller. It kept getting bigger, just as the mortality tables said it would. The whole scheme was a lie from the very beginning. They weren't selling you a self-funding insurance policy. They were selling you a financial time bomb, and the illustration was the misleading instruction manual that told you it was a Swiss watch. They used language designed to lull you into a false sense of security. It was a flexible premium adjustable life policy. Flexible sounds good, right? It means you're in control. Adjustable sounds sophisticated. What it really meant was the company could adjust the terms to their benefit, and the premium was flexible because you'd be forced to be flexible when they demanded more money to keep it from collapsing. They told you it was a private pension plan, or a 7702 account, using obscure IRS code to make it sound official and exclusive. It was a carefully constructed psychological game. The illustration was the board, the numbers were the pieces, and the goal was to separate you from your money by selling you a fantasy. And buried on page 27 of a 40-page document, in tiny 6-point font, was the disclaimer that said the whole thing was hypothetical and not guaranteed. The agent just flipped right past that page. The illustration was the map they gave you to a promised land of financial security. But the map was a lie. It conveniently left out all the cliffs, the deserts, and the predators along the way. And for millions of Americans who followed that map, the journey ended not in paradise, but in a financial wasteland. So what happened when the real world finally crashed the party? What happened when the interest rates started their long, steady decline through the 90s and 2000s? What happened when the carefully constructed fantasy of the illustration collided with the brutal math of reality? That's when the letters started to arrive. And that's when the dream officially became a nightmare. It began quietly, not with a bang, but with the soft thud of an envelope hitting the entryway floor. A letter just like any other. Standard white envelope, a small plastic window showing a name and an address. But inside was a statement that made no sense. A demand that felt like a betrayal. For millions of Americans who had dutifully paid their universal life insurance premiums for 10, 15, 20 years, this was the moment the dream shattered. Imagine you're one of them. Let's call you Bob. It's 2010. You're 68 years old thinking about retirement. Back in 1995, a very confident agent sat at your kitchen table. He showed you an illustration, a beautiful projection of your future. You bought a universal life policy. You were told if you paid, say, $300 a month, you'd have a $500,000 death benefit guaranteed for the rest of your life. And look, the illustration showed this amazing cash value account growing and growing, a wonderful safety net. For 15 years you've paid $300 every single month without fail. $3,600 a year. Over $50,000 paid into this policy. Then the letter arrives. It's from your life insurance company. You open it, expecting the usual annual statement. But this one is different. It's thicker. The language is dense, full of terms like insufficient premium, lapse projection, and in-force illustration. You cut through the jargon and find the terrifying bottom line. Your policy, the one you've paid into for 15 years, is projected to terminate, to lapse worthless in 18 months. To prevent this, your new required premium is no longer $300 a month. It's $1,200 a month, a 400% increase. Your heart sinks. This has to be a mistake. You call the 800 number. You talk to a customer service representative who sounds like they've had this exact same call 100 times today. They pull up your file, and they confirm it. It's not a mistake. You ask, how is this possible? I paid what I was told to pay. I never missed a payment. And the representative explains in a flat, monotone voice what went wrong. And what they're describing is the sound of a financial time bomb, a bomb that was placed in your policy on day one, finally detonating. Here is the brutal, hidden math of what happened to Bob, and to millions like him. Remember the two-part structure of universal life? A term insurance component and a cash value savings account. The premium you pay is supposed to do two things: pay for the term insurance and fund the savings account. The first problem was interest rates. That beautiful illustration from 1995, the one that sold you the policy, it was based on the high interest rates of the time, 8, 9, maybe even 10%. The agent probably told you. And this is a conservative projection. But it wasn't. Interest rates didn't stay high. They fell. And they kept falling. Through the 2000s, they plummeted. So the interest being credited to your cash value account wasn't 9%. It was 5%, then 4%. Then maybe even less. Your cash value wasn't soaring like a rocket. It was barely getting off the ground. But that was only half of the equation. The other half was the monster lurking in the shadows. The cost of insurance. See, the term insurance part of your universal life policy isn't a flat cost. It's what's called annually renewable term, which means every single year, as you get 1 year older, the actual internal cost to insure your life goes up. When you're 53, it's a small increase. When you're 63, it's a much bigger increase. When you're 73, the cost starts to increase almost exponentially. It's a curve that starts low and flat, but in your later years it goes nearly vertical. This was the design. The policy was engineered so that in the early years, your premium was much higher than the low cost of insurance. The excess, supercharged by those high interest rates, would build a mountain of cash value. Then, in the later years when the cost of insurance skyrocketed, that mountain of cash value would be there to pay for it. The earnings from your cash account would cover the massive internal charges, and your premium could stay nice and level. It was a beautiful theory. Perfect balance. But it required one thing to be true: high interest rates. When the interest rates collapsed, the entire balance was destroyed. Your cash value grew at a crawl. Meanwhile, the cost of insurance inside your policy didn't care about the economy. It was based on actuarial tables. You were getting older, so the cost was going up. Relentlessly. Inevitably. For the first 10 or 12 years, you didn't notice. The premium you were paying was still enough to cover the slowly rising cost of insurance. But then you crossed a threshold. A tipping point. The year came when the internal cost of insurance became more than the $300 premium you were paying. Let's say at age 66, the internal cost was $320 a month. You're only paying $300. So where does the extra $20 come from? The insurance company starts taking it directly from your cash value. At first it's a small drain, $20 a month. Then the next year you're 67. The cost of insurance is now $350 a month. Now the policy is eating $50 a month from your cash value just to stay alive. The year after that, it's $90 a month. You've entered the vicious cycle. The policy is now feeding on itself. And because your cash value is shrinking, it's earning even less interest, which makes the problem even worse. The drain accelerates. The mountain of cash that was supposed to fund your old age is being devoured from the inside out. And you, Bob, had no idea. Your annual statements might have looked okay. The numbers were confusing. But you kept paying your $300, trusting the system, until the cash value was almost gone. That's what triggered the letter. That's when the company's computers flagged your policy for a projected lapse. The company was telling you that the self-destruction was nearly complete. Your only option to stop it was to start paying a premium that covered the true current cost of insuring your 68-year-old life, plus enough to rebuild some cash value. And that cost wasn't $300. It was $1,200. This is the impossible choice millions of older Americans faced. You're on a fixed income. You can't possibly afford this new astronomical premium. Your health might have declined. You're probably uninsurable anywhere else. So your options are horrific. 1. You walk away. You let the policy lapse. You lose every single one of the $50,000 you paid in over the last 15 years. You get nothing. Your family gets nothing. The insurance company keeps all your money. 2. You surrender the policy. You ask for whatever little cash value is left. Maybe after all that time it's only a few $1,000s. You get a check for a fraction of what you paid in and your coverage is gone forever. 3. You try to pay. You drain your retirement savings, you cut back on everything trying to feed this monster that your policy has become, hoping you don't outlive your money. This wasn't a few bad policies. This was a systemic, industry-wide crisis. A generation of consumers who bought these products in good faith were now facing financial ruin in their golden years. The lawsuits piled up. The headlines were brutal. The term universal life became toxic. The industry was facing a catastrophe of its own making. They had sold a dream based on a fragile assumption, and when that assumption proved false, the dream morphed into a nightmare. The insurance industry had a choice. They could admit the fundamental design was flawed, or they could innovate. They could create a new, more exciting, more complex version of universal life. A version they could claim had solved the interest rate problem. A version with illustrations that looked even more spectacular than the old ones. They needed a new story to tell. And the story they invented was called Indexed Universal Life. But was this new product a genuine solution for consumers? Or was it just a more sophisticated, more confusing, and potentially even more dangerous trap? To understand Indexed Universal Life, or IUL, you have to understand the genius of its marketing. It wasn't just a new product. It was a masterpiece of financial storytelling. Imagine you're sitting across from a slick, confident advisor in the early 2000s. The dot-com bubble has just burst. People are terrified of the stock market. Their 401(k)s have been cut in half. They're looking for safety, but they also know they need growth to retire. They feel trapped. And this advisor leans forward and says, "What if I could offer you a way to participate in the stock market's gains, but with none of the risk? What if, when the market goes up, you make money, but when the market crashes, you lose nothing? Zero. Your principal is completely protected." You'd lean in, right? Sounds impossible. It sounds like the holy grail of investing. This was the core promise of Indexed Universal Life. It was designed to hit the two biggest emotional buttons for American consumers: greed and fear. You get the upside, the greed. You're protected from the downside, the fear. How could you say no? Here's how they explained it. The insurance company takes a portion of your premium payments and links the growth of your cash value to a stock market index, most commonly the S&P 500. They tell you that your money isn't actually in the stock market. Oh no, that would be risky. Instead, it's sitting safely with the insurance company. They just use the performance of the index to calculate how much interest they'll credit to your account each year. And here's the magic. They introduce two concepts, the floor and the cap. The floor, they say, is your safety net. It's almost always set at 0%. This means if the S&P 500 has a terrible year and drops 20, 30, even 40%, your cash value account is credited with 0% interest. You don't lose a penny from the market crash. You hit the floor. You're safe. Compare that to your buddy's 401k that just got vaporized. You feel like a genius. Then there's the cap. This is the trade-off for that safety. The insurance company says, since we're taking on all this risk for you, we have to limit your potential upside. So, if the S&P 500 has a fantastic year and goes up 25%, you might only get credited with the cap amount, which could be, say, 10%. You don't get the full market return, but hey, a 10% gain with zero risk of loss? Most people would take that deal in a heartbeat. So the story is simple. Gains up to a limit with no losses. Stock market upside with bond-like safety. But that was only half of the story. The second half was even more seductive. The advisor would then lower their voice, as if sharing a secret only the wealthy know. And the best part? All of this growth, all of it, is potentially tax-free. They'd explain that, just like a Roth IRA, the cash value in your IUL policy grows tax-deferred. But unlike a 401k or a traditional IRA, when you retire, you can access that money completely tax-free. Not through withdrawals but through policy loans. You borrow against your own cash value, and since it's a loan, it's not considered income by the IRS. And these loans, they'd often whisper, don't even have to be paid back. When you pass away, the insurance company simply deducts the loan balance from the death benefit before paying your heirs. So let's recap the sales pitch. It's an investment that gives you stock market-linked growth. It has a built-in safety net, so you can never lose money from a market downturn. All your gains are tax-free. And, as the cherry on top, it comes with a massive death benefit to protect your family. It was presented as a 401k, a savings account, and a life insurance policy all rolled into one perfect, tax-proof package. They called it the rich man's Roth. They sold it as a way to be your own bank. It was, on paper, the perfect financial product. It solved every problem and eliminated every fear. And for a while it worked. The market after the dot-com bust recovered. Interest rates were still reasonably high. The illustrations looked fantastic, projecting people becoming tax-free millionaires just by paying their premiums. The industry had found its new golden goose. But there's a fundamental rule in finance and in life. If something sounds too good to be true, it almost certainly is. And the beautiful, simple story of IUL was hiding a dark, complicated, and very expensive reality. The storytellers, the insurance agents, were leaving out the most important parts. Let's start with that cap, that 10% limit on your gains. It sounds like a fair trade-off for safety, but what they don't emphasize is the power of compounding. When you simply invest in an S&P 500 index fund, you get all the growth. In a year the market is up 22%, you get 22%. In a year it's up 30%, you get 30%. You get the monster years that pull the average up. With an IUL, you're permanently cut off from that true growth. Over 30 years, the difference between capturing the full market return and being capped at 8, 9, or 10% isn't a small difference. It's a catastrophic difference. It can be the difference between retiring with $2 million and retiring with $800,000. The cap is a permanent, heavy anchor on your growth potential. But the real deception isn't the cap. It's the floor. That zero is your hero promise. The idea that you can't lose money. This is, to put it bluntly, a lie. It's a clever manipulation of language. You see, the 0% floor only applies to the interest credited from the market index. It does not apply to your actual cash value. Remember, this is still a life insurance policy. And life insurance has costs. Massive costs. Every single month, whether the market goes up, down, or sideways, the insurance company is reaching into your cash value account and pulling out money. They're taking out the cost of insurance, which gets more and more expensive every single year as you get older. They're taking out premium load fees, administrative fees, policy fees, and surrender charges. So let's replay that scenario. The S&P 500 crashes by 20%. Your agent happily tells you that your policy was protected by the 0% floor. You didn't lose anything to the market. But what they don't tell you is that while you were being credited 0% interest, the insurance company was still siphoning out 3, 4, or 5% of your account value in fees and costs. So you did lose money. You lost it to the company. Your cash value went down. The 0% floor isn't a floor for your money. It's a floor for the insurance company's profit. It ensures that even in the worst of times for you, they are still getting paid. This is the first crack in the beautiful facade of IUL. The growth is heavily capped, and the safety net is an illusion that hides the slow, steady erosion of your cash value by internal costs. But this is just the beginning. The cap and the floor are the simple, easy-to-understand parts of the trap. The real mechanisms that make these policies so dangerous are buried even deeper in the fine print. The insurance companies gave themselves other levers to pull, other ways to stack the deck in their favor, ensuring that the house always wins. They created things called participation rates and asset fees or spreads, terms that sound boring and technical, but in reality, they are the gears of a machine designed to transfer wealth from your pocket to theirs. And understanding how those gears work is the key to understanding the entire IUL puzzle. So let's open the hood on this machine. Let's look at those gears one by one. Because when an agent shows you that glossy illustration projecting a life of tax-free retirement income, these are the costs they're hoping you don't ask about. These are the details buried in the fine print of a 100-page contract. The first gear is the most obvious, the premium load. Think of this as the cover charge to get into the club. The moment you write that first check, the insurance company takes a slice right off the top. It can be anywhere from 5 to 15% of your premium. So, if you pay $1,000, $100 or more might immediately vanish to cover commissions for the agent and the company's administrative costs. Your money is already starting in a hole. Next, you have the monthly administrative and policy fees. These are the little maintenance charges. They might seem small, $10, $20, maybe $30 a month. But over 30 or 40 years, that's thousands of dollars being siphoned out of your policy, regardless of how the market performs. It's a constant, steady drain on your cash value. A slow leak you might not even notice until it's too late. But those are just the appetizers. Now we get to the main course, the single most destructive gear in the entire IUL machine, the cost of insurance or COI. This is the part that every IUL owner needs to understand with crystal clarity. The cost of insurance is the actual pure cost for your death benefit. It's what you pay for the life insurance part of your life insurance policy. And here is the brutal, non-negotiable truth. This cost is not level. It increases every single year you are alive. Let me repeat that. The fundamental cost inside your IUL policy is designed to go up year after year after year. When you're young, say in your 30s, the cost is tiny, pennies on the dollar. But as you move into your 40s, 50s, 60s and beyond, that cost begins to climb. It's not a gentle slope. It's an exponential curve. It's like climbing a staircase where each step is taller than the last. In your 70s and 80s, those costs can become astronomical, morphing from a small monthly deduction into a ravenous monster that devours huge chunks of your cash value. This is the ticking time bomb inside every IUL. The glossy illustration you were shown likely projected your cash value growing in a beautiful, smooth upward line. What it didn't emphasize is the other line on the graph, the cost of insurance line, that is also screaming upwards, trying to pull your cash value down to zero. It's a constant battle. And it's a battle that gets harder and harder for you to win as you age. And if you ever think, this is too expensive, I want out, well, the insurance company has a gear for that too. It's called the surrender charge. This is the penalty box. For the first 10, 15, or even 20 years of the policy, if you want to walk away and take your cash value with you, the company will hit you with a massive fee. These surrender charges are often so high in the early years that you could walk away with less than half of what you paid in, or sometimes nothing at all. They are the golden handcuffs designed to keep you in the policy long enough for the other fees to do their real damage. Now let's talk about the gears that control your growth. This is where the marketing magic happens. You're sold the idea of market upside with no downside risk. Sounds incredible, but how do they do it? They do it by severely limiting your upside with a trio of restrictions: the cap, the participation rate, and the spread. First, the cap. This is a hard ceiling on your potential earnings. The insurance company might say the cap is 9%. That means even if the S&P 500 has a fantastic year and goes up 25%, the absolute most your account can be credited is 9%. You get a small piece of the good years and they keep the rest. They take all that extra return and use it to fund the policy's guarantees and, of course, their own profits. So right away, the idea of market-like returns is an illusion. You're playing a game with a ceiling you can never break through. Second, the participation rate. This one is even more subtle. A participation rate determines what percentage of the index's gain you are even eligible for. For example, the policy might have a 75% participation rate. So, if the S&P 500 goes up 10%, you don't get credited on 10%. You get credited on 75% of that gain, which is 7.5%. And that's before the cap is applied. So you're already taking a haircut on the returns before you even hit the ceiling. And finally, you have the spread. This is perhaps the most direct way the company takes its cut from your growth. A spread is a percentage that is subtracted directly from the index's return before your interest is calculated. If the policy has a 2% spread and the index gains 10%, they first subtract their 2%, and your interest is calculated on the remaining 8%. It's a guaranteed fee for them, taken directly from your potential gains. So let's put it all together. Imagine a great year in the market. The S&P 500 is up 20%. The agent told you you'd participate in that. But your policy has a 75% participation rate, so you're only eligible for a 15% gain. Then your policy has a 9% cap, so that 15% is immediately slashed down to 9%. That is the absolute best case scenario for you. You get 9% while the market did 20%. But remember, you don't actually get 9%. That 9% is just the gross credit. From that, the insurance company still has to deduct all the other gears, the monthly administrative fees, and, most importantly, that ever-increasing cost of insurance. In a good year, that 9% credit might be enough to cover the costs and add a little to your cash value. But what happens in a flat year? Or a down year? The market goes down 15%. Your floor of 0% kicks in, which sounds great. You didn't lose money from the market. But you are not at zero. The gears of the machine don't stop turning just because the market is down. The premium loads, the administrative fees, and that massive, growing cost of insurance are all still deducted directly from your cash value. So in a 0% year, your cash value is going down. You are losing money. This is the fundamental, fatal flaw of IUL. The marketing focuses entirely on the 0% floor, making you feel safe. But it distracts you from the internal bleeding caused by the costs. The policy is structured so that the insurance company wins no matter what. In up years, they cap your gains and keep the difference. In down years, your cash value is protected from market loss, but it's still being eroded by the guaranteed, ever-increasing internal costs. It's a machine designed to grind your wealth down over time. The illustrations project a fantasy where the market consistently delivers just enough returns to hit the cap, year after year, while assuming the costs of insurance stay manageable. But reality is messy. You'll have years of great returns limited by the cap, and you'll have years of flat or negative returns, where the costs eat away at your principal. Over decades, this combination of capped upside and guaranteed internal costs creates a powerful headwind against your money. It's a slow-motion train wreck, where the rising cost of insurance is on a collision course with your cash value. And the tragic part is that this collision is designed to happen later in life, in your 60s, 70s, and 80s, precisely when you need the money most and are most vulnerable. That's when the cost of insurance truly explodes, and a few bad years in the market can be catastrophic, potentially wiping out decades of savings. So what happens when the rising costs finally collide with a period of low returns? What does a policy lapse actually look like? And what are the devastating tax consequences that no agent ever talks about? That's the final critical piece of the puzzle we'll uncover next. The year is 2045. A 72-year-old man named Robert sits at his kitchen table, staring at a letter from his life insurance company. He bought this universal life policy 30 years ago, in his early 40s. The agent, a nice young man, showed him beautiful illustrations, projections that showed his cash value soaring, creating a tax-free retirement nest egg while protecting his family. For 3 decades, he paid his premiums faithfully. He even took out some of those tax-free policy loans to help his daughter with a down payment on her first home. He felt smart, responsible. But now the letter in his hands feels like a threat. The premium, which was once manageable, has doubled in the last 5 years. This letter informs him it's about to double again. To keep his policy, the one he sunk over $150,000 into, he'll now need to pay nearly $20,000 a year. On his fixed retirement income, that's not just difficult, it's impossible. Robert is standing at the edge of a cliff he never knew existed. This is the moment the policy implodes. This is the anatomy of a lapse. What happened? It's a slow-motion disaster that begins with something called the crossover point. Remember, inside every universal life policy, there are two competing forces: the cash value, which hopefully grows with interest, and the cost of insurance, which is guaranteed to rise every single year as you get older. In the early years, the cost is tiny, but as you enter your 60s and 70s, that cost starts to rise exponentially. It's like a tiny leak in a boat that, over time, becomes a gaping hole. The crossover point is when the monthly cost of the pure insurance becomes greater than the premium you're paying. From that moment on, the policy starts to eat itself alive. The company begins pulling the difference directly from your cash value to cover the ever-increasing cost of your death benefit. First, you might not even notice. The annual statements look okay, but under the surface, the engine is burning through its own fuel. And if you're in a period of low interest rates like we've seen for much of the last 2 decades, your cash value isn't being replenished. The boat is taking on water faster than you can bail it out. Soon, the company sends the first letter. It's a gentle warning. Your policy is underperforming. They recommend you increase your premiums. A few years later, the second letter arrives. The tone is more urgent. Your policy is in danger of lapsing. You must increase your premiums. And then you get the letter Robert is holding, the final ultimatum: pay this astronomical new premium, or the policy will terminate. At this point, you have 3 devastating choices. Choice 1, pay the ransom. You drain your savings, cut your retirement budget to the bone, and pay the massively inflated premiums just to keep the death benefit you were promised. You become a slave to a policy that was supposed to set you free. Choice 2, surrender the policy. You give up. You call the company and say, "I'm done. Just send me whatever cash value is left." You walk away, accepting the loss of decades of payments, feeling defeated and betrayed. But what you don't realize is that you're not just walking away. You're walking straight into a tax trap. Choice 3, do nothing. You can't afford the new premium, so you just stop paying. The policy officially lapses. This feels like the same as surrendering, but it's often the worst possible outcome. Because in the eyes of the IRS, a lapse and a surrender are treated almost identically, and both can trigger the single most dangerous, least disclosed secret of universal life insurance: the phantom income tax bomb. This is the part no agent ever wants to talk about. We're told that policy loans are tax-free. We're told cash value growth is tax-deferred. And this is true, but only as long as the policy remains in force until you die. The moment it lapses or is surrendered for a gain, the rules change and the IRS comes knocking. Here's how the tax bomb works. The IRS looks at 2 numbers. The first is your basis. That's the total amount of premiums you've paid into the policy over its entire life. The second is the total value received. This is the cash surrender value you get back plus the total amount of any outstanding loans you've taken. If the value you received is more than the premiums you paid, that difference, that gain, is taxable as ordinary income. All in 1 year. Let's go back to Robert. Over 30 years, he paid $150,000 in premiums. That's his basis. 10 years ago, he took out that $80,000 policy loan for his daughter's house. He never paid it back because his agent told him he didn't have to. It would just be deducted from the death benefit. Now, at age 72, his policy is about to implode. The rising costs have eaten his cash value down to almost nothing, say $5,000. He can't afford the new $20,000 annual premium, so he lets the policy lapse. He thinks, well, I lost all my money. I paid in $150,000 and the insurance company is keeping it all. It's a total loss. But that is not what the IRS sees. The insurance company sends him a final statement and a Form 1099-R. They report to the IRS that Robert received a total distribution. He got the remaining $5,000 of cash value, and his $80,000 loan was forgiven. In the world of taxes, loan forgiveness is income. So the IRS says Robert received a total of $85,000. But wait, it gets worse. Let's imagine his cash value had grown well over the years before the costs started eating it. Let's say he'd taken out $200,000 in loans against a large cash value, while only paying in $150,000 in premiums. Now he's 75, the policy collapses. The loan of $200,000 is forgiven. The IRS sees a distribution of $200,000. His basis, what he paid in, was only $150,000. That means he has a taxable gain of $50,000. This is phantom income. It's money he doesn't have. He spent it a decade ago. But he is now getting a tax bill on $50,000 of income all at once in a single tax year. For a retiree on a fixed income, a sudden tax bill for $10,000 or $15,000 can be catastrophic. It can mean the difference between a stable retirement and financial ruin. This is the dirty secret. The tax-free loan is only tax-free if you die with the policy intact. If the policy dies before you do, the loan comes back from the grave as a taxable monster. So what can you do? How do you avoid this nightmare scenario? If you have a universal life policy, especially an older one, your inaction is your greatest enemy. You need to act now. First, call your insurance company immediately and request an in-force illustration. Do not ask for a summary. You need the full multi-page document. Specifically, ask them to run the projection based on current interest rates and the maximum guaranteed charges. And this is critical, tell them to run it to maturity age 100 or 121. This document is the unvarnished truth. It will show you year by year, if and when your policy is projected to crash and burn. Second, when you get that illustration, look for the crossover point. Find the year where the internal costs become larger than your premium. Watch what happens to your cash value after that. Does it start to plummet? Does the projection show the policy lapsing at age 80? Age 85? If it does, you have a ticking time bomb on your hands. Third, you have options, but they shrink the longer you wait. You can perform what's called a 1035 exchange. This is a provision in the tax code that allows you to move the cash value from your failing life insurance policy directly into a new, more stable policy, or even an annuity, without triggering a taxable event. You could potentially exchange it for a guaranteed universal life policy with a no-lapse guarantee, or a paid-up whole life policy with a smaller death benefit but no more premiums. This can be a lifesaver. Another option is to drastically reduce the death benefit. Remember, the cost of insurance is based on the net amount at risk, the gap between your death benefit and your cash value. By lowering the death benefit, you dramatically reduce that cost, which can release the pressure on your cash value and potentially make the policy sustainable for the long haul. The goal of this entire series has been to pull back the curtain on a product that is often misunderstood. Universal life insurance is not inherently bad. It's a sophisticated tool that, when used correctly and monitored vigilantly, can be effective. But it was sold for decades with unrealistic promises, illustrated with interest rates that never materialized, to millions of people who were told to just set it and forget it. That is the worst possible advice. Your financial security is too important to be forgotten. Don't trust a 30-year-old illustration. Demand to see the truth of your policy today. Ask the hard questions. Understand the costs. And remember, the most expensive insurance policy you will ever own is not the one with the highest premium. It's the one you don't understand.